Welcome to this Ratio dialogue with Professor Andrei Shleifer from Harvard University. He's here in Stockholm to give the yearly Eli F. Heckscher lecture. And the theme of his lecture is A Crisis of Beliefs, Investor Psychology and Financial Fragility. So that's also the title of a new book coming out later on this fall with Nicola Geniaioli from Italy. And this book and this lecture deals with the financial crisis in 2008, 10 years ago, and what we can learn from it, and what we can learn about, well, the stability, I guess, of financial markets. And you, Andrei, you're quite critical towards some of the established views here. In particular, I would say a more rationalistic belief that financial markets, in fact, or actors on financial markets act in a traditional, rational way.
Yes, I think that's one of the themes of the book. I think it's fair to say that the dominant paradigm in economics and in finance is the paradigm of rationality. But if you think about what happened during the financial crisis, you saw that it occurred on the back of a housing bubble, which was very much a standard bubble with far from rational beliefs. So it occurred with many people being extremely enthusiastic about housing, borrowing a lot to buy houses, banks lending a lot to let people buy houses. There was a lot of financial engineering supported by all kinds of optimism that...
It seems like everyone misunderstood the basic situation here.
That's right. There was a universally shared optimism, and so the crisis occurred when this optimism was disappointed. And the banks in particular lost a tremendous amount of money and collapsed and had to be saved by the government.
So on this very general level, I guess most economists and policymakers would agree with you that all these mistakes were made and people didn't see this bubble. But you're also specifically critical to some of the major ideas that are used to explain this kind of irrational behavior or systematic irrationality, at least. And in particular, let's start with you're critical towards the moral hazard argument that has been dominated, I think, in the analysis of the crisis, and the too big to fail argument. Can you expand this a little bit, please?
Yeah, the essence of the too big to fail argument, as I see it, is that banks were tricking everybody. So that is to say that banks knew that housing was in a bubble, that mortgage-backed securities were inappropriately priced, that they understood that everything was not what it seemed, but they nonetheless gambled and made these bets and expected to be saved, exactly. Yeah. And I think if you look at the evidence is very clear that the banks were as confused and as optimistic when the housing bubble was growing as policymakers, as investors, as home buyers, as everybody else. So it was a widely shared error of understanding rather than an attempt by the banks to trick people gambling on resurrection.
So this dominating idea about moral hazard and too big to fail, in your opinion, is wrong, basically.
It's not what happened.
It's not how it happened. So the other big argument is like a bank run or a fire sale argument, I guess. You're also critical, not as critical, I think, but you don't really believe that's the whole story either.
Well, the way bank runs obviously something that happened, and they're obviously something that was important. But I think it's a mistake to think that the crisis is bank runs. bank runs is what happens at the end of the crisis, which is to say you have the collapse of the housing bubble, you have banks in the United States losing hundreds of billions of dollars over the course of 2007, 2008. And then when it all looks like it's the end, or close to the end, then you have a bank run and a total collapse and government rescues.
That's what happened, wasn't it?
That is exactly what happened. So in order to understand the crisis, you sort of need to understand all the things that happened before the bank run and how we got to the bank run. Let me give you an analogy which may be helpful. If you look at hospital records for the reason why people die in hospitals, most people are recorded to die of heart failure. Maybe 80 or 90% of people who die in hospitals die of heart failure. But that's, of course, not how they come into the hospital. Come into the hospital with cancer.
That's not the cause of
That's not the ultimate cause. That's not the deep cause, you see. And so if you say that heart failure is the cause, the ultimate cause of people's deaths at the hospital, that's totally misleading. That's exactly like saying that bank runs is the ultimate cause. They're the last spasm, if you like.
That's the consequence of something that happened way before, right?
It's a consequence of something that happened way before, and it actually matters. I can tell you why it matters, because if you believe that the crisis and the bank run are the same thing, that leads you to think that you couldn't have done anything, right? That it was lightning from the sky, the bank run. And so you can't expect regulators or financial authorities to have done something in advance. Whereas if you think that the bank run is something that happens at the very end, that raises the question about what about the whole period leading to the bank run? Was there an opportunity to do something, to stop it, to prevent it, to stabilize the financial system in advance? That's why this is not just a theoretical argument, but it actually matters.
It matters. And in your story of the Lehman crisis, had a pivotal role, I think, and
it was that last spasm. It was that
that's what
heart
triggered
failure.
the bank run, and everyone became
that's right.
even more irrational in a sense.
Well, that's what caused the panic,
Yeah,
yes. But there was a lot of stuff going on prior to that where you could see the crisis coming. Not for certain, but with a high likelihood.
You should have seen it coming, right?
Should have seen it coming.
So this is in a sense a critique not only of financial actors, but of financial economists as well, isn't it?
I think that everybody
has something
shares shares some blame and has something to learn, maybe a lot to learn from this situation. And I think it's actually interesting because there's been a lot more focus, both of research and of central banking policy making on financial stability since the crisis as a consequence.
I like to come back to that question, whether financial actors or markets can learn. I think that's a very interesting issue, actually. But you have another theory, if you want, or another explanation for what really happened on these markets and what triggered the crisis and how it developed. And it's focused on expectations. Could you explain this to us a little bit?
Yes, at some level, the explanation that we pursue in this book is a very old historical explanation. This goes back to the work of Charlie Kindleberger and Hyman Minsky and other economic historians who were focused on bubbles and crashes after bubbles and the consequences of crashes for the economic system, and also on the work follows from the work of behavioral economists like Robert Shiller that says that the antecedents of a financial crisis is a period of exuberance. In the case of the U.S. crisis, it's exuberance in the housing market, of a bubble in the housing market, of increases in borrowing and leverage.
Over-optimism.
Over-optimism. Yeah. And of that you could see in expectations data that was actually measurable in the data of expectations of various financial actors as well as regulators, but also the deterioration of this bubble and a very, very slow recognition that the bubble is deflating, leading to a financial
And how can we explain this, building on Kinderberg and others?
Well, the bubble part and the collapse of the bubble and credit expansions, those things we understand pretty well, which is to say that bubbles usually arise during the period of financial stability and very good economic news and low volatility, that what leads them to inflate, if you like, that they sow the seeds of their own destruction, because when reality intervenes, we don't know exactly when reality intervenes, but at some point reality intervenes and bubbles begin deflating. And the question is not, does that happen? I don't think there is much disagreement anymore as to whether this happens. I think the question is, how do you deal with it?
We will have these cycles.
We will have these cycles. And the question is whether, for policymakers, for investors, is whether you respond to this deflation earlier or later, whether you really wait for the crisis or close to the crisis because you're never sure, or whether you want to stop the unraveling faster.
But I understand you correctly. You argue that extrapolations of the ongoing trend, so on, tends to be, well, too forceful. They tend to believe that the way things are now, it should continue more or less forever, you know.
Extrapolation, again, if you can just look at the data on what people say they believe and how they act.
Yeah.
And you don't need to look very hard to find evidence of excessive extrapolation.
But you also add another element to this theory. You call it, well, kind of actors underestimate unrepresentative risk. That would be your formulation.
Yes.
That, well, can you explain this? Why did they do this, and how was this important in this crisis?
Well, one of the consequences of this excessive optimism is something that sometimes referred to as the black swan phenomenon, which is that when you're very optimistic about the future, you forget the downside risk. And in some sense, downside risk might not matter, except when you have a lot of borrowing and leverage in the system. And when you forget downside risk, there is excessive borrowing because people don't think they can default, but it is also a perception, which was fundamental to that crisis, that debt is very safe, that debt cannot default, that debt is AAA. And that was an extremely important feature of the 2008 crisis, because one of the things that caused the collapse of the system is people realizing that debt that they thought was completely safe, that could never default, was in fact quite risky.
So tail risk was underestimated.
A byproduct, it's the same thing. It's two sides of the same coin. But the byproduct of excessive optimism was the neglect of downside risk, the tail risk.
And was this caused by well, bad regulations of the activities of Fannie Mae, Freddie Mac, and the belief that in fact there was a public state safety net to handle all these subprime loans and AAA.
Well, I think there is wide agreement that Freddie and Fannie and these government supported enterprises were at the heart of the crisis. In fact, one of the best things that the authorities did was to rescue them first, to nationalize them first, because if they went bankrupt, we would have had a much worse crisis.
That's a kind of a paradox, I think, in your presentation, that all of a sudden, after the crisis really hit, the actors, at least the official actors, improved quite a bit. They did the right thing for a couple of years there to save the system, more or less. But coming back to your theory, so it's a theory combining expectations, beliefs. You add on to that, leverage, of course, but also the psychology, in a sense, here, coming from behavioral economics and kind of recent understanding we had over the last 10, 15 years of how actual economic actors in fact behave,
I think that what we bring to the table, I'm sorry, I'm interrupting. What we bring to the table is a lot more data. So I think the basic story, as you said, is the Kindleberger-Minsky story. I don't think we're very unconventional in that regard, but what we bring to the table is a lot more precision and a lot more structure in trying to understand what the beliefs were, trying to measure beliefs, trying to model beliefs, and trying to understand what are the sources of these kinds of extrapolative expectations, how they deflate, and how their deflation can lead to extraordinary instability.
So if financial actors and regulators had been more attentive to survey data, they would have done better.
Well, there are two views of this. There are two views of this, which is interesting. So our view of this is yes.
Yes, because that's the way you argue it.
That is what the book says, that in fact that there was a lot of information that was available, certainly after 2007, to regulators that should have caused them to be much more proactive. I should just in fairness say that there is a view, at least some of the regulators, that they were aware that the financial system is extremely fragile, but there was nothing that they could do because of political constraints, because of other restrictions on what they could do.
Could forecasts be improved? Could the forecasts of central banks and financial regulators, even banks themselves, be improved if they use this kind of survey data in a more active way? Or
I think the answer to that is yes.
Yes,
I can tell you, maybe one of the most interesting fact that we report in the book, which is that there is a meeting of the Federal Open Markets Committee, which is the governing board of the Federal Reserve Bank in the United States, on August 5th, 2008, which is to say 6 weeks before the financial crisis. And they issue an extremely optimistic forecast about the growth of the U.S. economy. In retrospect, this forecast turned out to be very, very far off.
And in your view, it wasn't based on accurate data.
They obviously ignored the fragility of the financial sector. But I want to say one more thing, which is that the board for that meeting asks the economists at the Federal Reserve to prepare a forecast for, I can't remember what they called it, a nightmare scenario, extreme financial fragility scenario. And they prepare that forecast. And what that forecast says is that, maybe the U.S. economy will slow down a bit at the end of 2008, but by 2009, it's going to recover, and that the unemployment rate might peak at 6%, when in fact it peaked at 10%. So they really missed it completely.
And they saw that risk as quite small even.
And they saw that risk as quite small. And so in that regard, yes, I think that if the policy-making process and the forecasting process was more attentive to the indicators of potential fragility, forecasts could be improved.
Yeah. And when the crisis hit, when Lehman occurred and the government didn't save that bank, the market overreacted in your view. It became too pessimistic. But apparently regulators became more rational in a sense. They started to do the right things. How can we explain this?
Well, again, there are two explanations. I agree. The policy, I think, after Lehman
changed for the better.
Changed massively for the better, became more proactive. So there are two views of this. One is that the regulators actually understood that unless they intervene on a massive scale, the U.S. economy is going to really, truly collapse and collapse for a long time, maybe like the economy of Japan.
So they saved Merrill Lynch, AIG.
They saved Merrill Lynch, they saved AIG, they arranged mergers of many banks, they forced all banks, all big banks, to raise equity. They started the stress test that forced banks to cut dividends, to improve their capital, and so on. They became really, I think that it was quite brilliant, the policy after Lehman. The story that the regulators would tell, just to go back to to what we said, is that, well, they couldn't have done what they did after Lehman, before Lehman, because Congress allowed them to do all these things, and they would have done them before Lehman if they only could have done them. I'm not completely convinced by that.
But it's an interesting point, I think, you make there, that in a sense, sometimes policy makers argue a crisis we had to have. In this situation, you had a financial market, a housing market, a bubble that was quite irrational in a sense. And without Lehman, perhaps no one would have understood how bad the situation actually was.
Well, again, so our counter to that in the book, since you've raised this, is to say, look, Lehman had really a long time coming, which is to say that the first tremors in the financial markets happened more than a year before Lehman. And the authorities patched them up, and they patch up the problems in the banking system, and then they sit back and hope for the best. And as this happens, massive losses in the banking system, both in the United States and abroad, accumulate. So by the time of Lehman crisis, the banks, many banks, are really very close to a very dire financial situation. I don't know if I want to use the word insolvency, but certainly very close to that. And if in fact the authorities were more proactive from the start, and I think there were some things that they could have done much earlier, then perhaps the severity of the crisis would have been not as extreme.
I have a couple of questions in the end here about how general the theory is and whether financial markets can learn. But before that, I mean, all these are very complex things, and there are so many causes, it's not one cause, and you put the emphasis on expectations and beliefs.
Yes.
What about fraud, bad regulations, artificially low interest rates, credit expansion in itself?
I think you see fraud in all bubbles. I think it's a mistake to think that fraud was the cause. I mean, it was a bit of a problem, but it was not at the heart of what has happened. the expansion of leverage and excessive optimism are two sides of the same coin, which is to say that, when people are excessively optimistic, they buy homes, home prices rise, collateral value rises, people borrow, leverage expands, borrowing expands. Those are not separate phenomena.
No.
They're closely interlinked and interconnected. You raised the question of regulation. Look, the elephant in the room, as you said, was Fannie and Freddie, which is that you had these two quasi-governmental institutions.
That
goes
came
way back.
under Clinton, I think, and even
Probably
before.
Even earlier, yes. And those were the obviously most irresponsible agents in the whole system. And again, in fact, what the regulators would say, no, it didn't come under Clinton. I think there was an attempt by the Treasury under the Clinton administration to rein them in, or maybe not to shut them down, and Congress prevented that. So I think that people were worried about them for a long time. And just to finish this, I think that the people who were running the Treasury and the U.S. financial system in 2008 would say that their greatest accomplishment was to get enough support for nationalizing Fannie and Freddie, or putting them into some kind of a government control.
So in your view, all this securitization and pooling and tranching and AAAs from the rating agencies and so on is focused down to Fannie and Freddie in a sense, that the belief was that they was supposed to save the whole or secure the system in a sense.
I wouldn't go that far. I would say that there were two parts of securitization and two parts of two sources of financial stability. Again, both going back to optimistic beliefs and leverage. One was in the private sector, which was private label securitization, and one was in the quasi-public sector, which is Fannie and Freddie. And I think the sources of over-leveraging and extreme fragility in both were pretty similar, which is to say incorrect or excessively optimistic beliefs. But what I am saying is that the government rescued Fannie and Freddie right away, so that source of problems was eliminated very, very quickly, whereas the problems in the private side didn't go away and unraveled in a very dramatic way through Lehman and so on.
So that brings me over to my last discussion, really. Can actors on this market learn? I mean, we had this crisis. It's 10 years ago. We're still paying the cost in a sense for this turmoil that was quite disastrous in many ways. And you argue that policymakers learned dramatically when the facts became clear. They were not only able, but they also realized what to do in that situations. But now we had all these, artificially low interest rates for a decade. We have housing bubbles, not least in this country, but in many countries actually. And can financial markets learn? Can the actors, regulators, actors in this market, should we be optimistic about this? Or are these fundamental problems of extrapolative expectations and representative heuristics that you make such an important part of your theory? Or can we handle this in a sense?
Well, I don't think we should count on financial market participants learning. I think about 10 years ago,
they are too myopic.
My colleagues Reinhardt and Rogov have written a book. I guess Ken Rogov gave the Heckscher lecture.
He gave the lecture a couple of years ago.
Wrote the book called "This Time Is Different," that suggested that they don't learn. But I think what's important is that policymakers learn, and that not just individual policymakers, but that the framework of central banking and return or become much more focused on the question of financial fragility. So now we're still, as you said, 10 years after. So there's been a lot of learning by people who went through 2008, and there are certainly some countries in which financial stability is becoming part of the framework of central banking. But I think the success of dealing with these problems is going to turn not so much on individual actors who appreciate these things, because there are always going to be individual actors who don't, even in central banking.
Has there been overregulation in your view, or have the politicians and policymakers handled this in a sensitive way?
I think that I would say the following. I would say that the general direction of policy toward stress tests and toward better capitalization of the financial system, that general theme has been very effective and very successful. I think there were some regulations that are unquestionably stupid, like the Volcker rule. I don't think that anybody who understands anything thinks that Volcker rule was a good idea, and there were many other
so there were like overreactions.
There was regulatory overreactions. I think there are some areas in which there's been probably less of a move in a good direction, which is to say that I think that it's important to, so one form of overreaction is that the U.S. law now has all kinds of provisions against bailouts of financial institutions in distress, and I think these bailouts, unfortunately, are an absolutely essential tool of economic policy. So that's where policy overreacted by going in the wrong direction rather than the right direction.
Too big to fail argument is basically wrong. Yeah.
The too big to fail argument, which is basically wrong.
Oh, I think we will end on this optimistic note that at least policymakers have learned. Not perfect, we know that, but policy regulations have improved over time, and there's been some learning going on here. You're less optimistic about the financial actors themselves, but there are money to be made, I think, to become more rational here. And
by somebody.
By somebody. Thank you so much, Andrei, for
Thank
coming
you.
here to Stockholm, and it's been a pleasure. Thank you very much. And thank you for listening.